Right, good morning, everybody. I think I've got the technology sorted out. We are back in our new office and slightly different setup, but I think we've got the technology going. I'm going to run through a bit of news. Richard's got something to talk to as well. And then I'm going to be talking to Jean Rush of Australia Midcap. Just a little reminder on this slide, if you haven't seen it already, we've got our property conference coming up. I know we'll probably mention it at the end too, but if you haven't signed up for that, please think about doing so on our events website. So if I can work, there we go. News, few little stories really. HydrogenOne has done an acquisition this morning. I think it's worth digging into a little bit. RTW Ventures had a takeover, which is quite good news for its NAV. And there's been some more news on the social housing sector, which is what Richard's going to talk to in a second. HydrogenOne first. I think we know that the discounts really opened up on this one, but the NAV has been quite stable, and obviously it's been quite stable because its investments are still relatively new, so it's not been revaluing things. But it is notable, I think, that the discounts widen way further than the listed hydrogen stocks have fallen. So I just think that's completely overdone. Hang on, I've got one minute. I'll do that. So what it's done this morning is to put some money into Carthew Aerospace. Alongside the deal that's going on there, but to sort of recap on that deal, this is something they first invested into on the 24th of March, and it is trying to develop hydrogen-powered aircraft. It's got a grant from the government to do that, and it's aiming in the first instance to get the flight certification for a fuel cell-powered 9-seater Britain Northern Islander. It's a little picture of one of those there on the screen. Safran is a big French engineering firm, has invested alongside HydrogenOne in this, and it's providing some of the technology, but there are other technology collaborators working on this too. I think because this is such a sort of big prize, somebody can pull it off. What they've announced this morning is that the actual plane makers and Carthew Aerospace are going to merge. They're targeting to get one of these aircraft, or also at least one of these aircraft, into service for 2026, and they're going to be making test flights next year. HGen is putting some more money into it, so they're investing another £5 million. And altogether, that's part of another funding round that's about 10 million, but they're still raising money, so I think there's more to come on that. The reason why Carthew thinks it's going to work is because hydrogen is actually quite energy dense, and so therefore it's a much more efficient way of fueling an aircraft than, say, with batteries, or even like a hybrid solution. It adds extra weight to the aircraft, and that means that you end up having sort of minimal benefit in terms of CO2. Whereas pure hydrogen, however, obviously be completely zero emissions. And they make the point that you can actually make the hydrogen local if you've got the relevant technology on site. So it just makes it slightly more practical. This business was spun out of Carthew University in '97. The £9 million government grant in 2019 was to develop this hydrogen-powered aircraft. The money that HydrogenOne put in originally was part of the Series A financing, and it's £14 million there. They've already got letter of intent signed for over 80 aircraft, which is remarkable, really. These are quite short-range things, and so they're sort of fairly limited use, but nevertheless, there seems to be a lot of interest in them. And Air New Zealand has selected them as their potential partner for their zero emissions aircraft program. So they're basically trialing 3 different solutions. They're going to pick one of those to back at some point, I think this year or early next. So the target, as I said before, is to have planes certified in 2025, first commercial aircraft flying in 2026. By 2028, they reckon they'll be able to, let's say, run on liquid hydrogen. which means that they can run slightly bigger planes. And they do have ambitions to go all the way up to sort of 50 to 100 passenger aircraft, which is the normal range for regional aircraft stuff. All quite good if they can achieve it. And I do think that this is one of the more sort of speculative things that hydrogen's got. Most of these things, sunfire and alcogen, they're already producing electrolyzers and fuel cells. They've already got demand for stuff. Higher Rock looks really promising. They're developing stuff in connection with various industry partners. Strohm is doing the pipelines for hydrogen, carry hydrogen from offshore wind farms. There's all sorts of stuff in there which is less technology risky, I suppose. That's maybe yeah, and that's why you're putting it. But I think basically, although there is some risk around this, it would be quite exciting if they can pull it off. But I think HydrogenOne is actually a bit more solid than the Cranfield story implies. Definitely in terms of the generation plants, HH2 injecting, I think those are going to get off the ground fairly quickly. Which is why we think that discount's overdone. RTW Venture Fund is another one, same sort of story as hydrogen. So anything sort of remotely breakthrough, as we know, is derated, moved out to trade at a discount. I think, again, that's undeserved. You can see it there against the wider sector. It's on one of the wider discounts along with Syncona, but it has been much better than Syncona at picking up winners. So it's back in early stage biotech, but it just seems to be doing that more consistently than Syncona has done. But it nevertheless is still trading one of the wider discounts. But when you look at the returns, you look at the 3-year returns, it's the second best performing fund after the Tiny Adams. So I do think that discount is undeserved, really. What's happened this morning, or recently, sorry, this week, is that Merck is buying Prometheus Biosciences for almost $11 billion, which is a 75% premium to the prior closing price. This is something that we keep banging on about, that private buyers, corporate buyers, are putting much more sensible valuations on these businesses than investors in listed equities are. It was already almost 15% of the fund at the end of March. So this deal is set to add about 35 million to the NAV for about 11%. And it implies that the discount is now something close to 26%. I do think that just means it's a bit of a screaming buy at the moment, but it's up to you whether you think crudely or not. So that's that one. I'm now going to hand over to Richard for a bit. Let him run through the story this morning on social housing.
Hiya. Not sure why my video's not working, but it's probably a good thing. This morning there was an announcement by TriplePoint regarding yesterday's announcement by the regulator on Auckland homes. So this is a housing association in the social housing sector, which makes up it's the second biggest tenant for Civitas and also almost 5% of the income for TriplePoint social housing. So the enforcement notice on Auckland Home follows regulatory non-compliance notice, which was issued in 2021 on the company. And they've got serious concerns about sort of the governance and business planning of this company. Also mentioned about potential conflicts of interest, which they don't feel are being addressed by the company, which I'll talk about in a sec. And they've forced Auckland to commission an independent review into developing an action plan and a timetable to become compliant, and also put on 3 new members of their board. So on to the next slide. So in regards to the conflict of interest, so Auckland's principal shareholder is the Social Housing Family CIC, which was set up by Civitas a couple of years ago. which they say is operationally completely independent from Civitas, and was set up to basically meet some of these requirements of the regulator to help these housing associations to improve their skills and experience, and also to provide funding if they need it. As I said, it's completely separate, but obviously the regulator may have a bit of an issue with that on conflict of interest. But as far as we're concerned, we don't see too much conflict there. And if you see these regulatory notices on the house associations, have a big impact on the share price of both companies over the years. If we see on the next slide. So this is Civitas. I could have put up Triple Points as well. They look pretty similar over the last 5 years. So regulatory notices dented the share price at each, as you can see there, whereas NAV has sort of notched up fairly consistently. So if we look at sort of towards the end of 2021, that was when the short seller report came, and you see the impact that's had, and it's just never recovered. And then the end of last year, discount widened further, and I believe that's because it's sort of been tarred with the same brush as home REIT. So we, on the next slide, we'll have a look at what we think's happening there. So home REIT, obviously everyone knows what's happening there. A lot of seems to be misappropriation, just a lot of stuff going on there that isn't a good look on the company, and we'll see what's going to happen with their future. But this has definitely been impacted the two social housing funds and their share price, and we think unfairly, and the reasons why are listed there. But they're completely different subsectors with completely different characteristics. So firstly, the social housing sector is regulated, whereas the homeless sector isn't, which means unscrupulous housing associations are identified, which obviously hasn't been the case with home REIT. Secondly, this high acuity care is given at the vast majority of the social housing properties, which require the homes to be specially adapted to meet those requirements. Again, this hasn't been the case in the homeless accommodation, which allowed home REIT to buy all these sort of substandard properties. Due to the care needs of the underlying tenants, there'll be residents at these homes for long term. So I think the average age in Civitas portfolio is around 35 years. So that they're going to be there for the long term. And this is why the manager argues that long leases are appropriate in this sector to match up with the long-term care needs of the underlying tenant. The properties that Civitas and Triple Point provide not only save money for the taxpayer, with the alternative being in hospitals and in NHS facilities, but they've also proven to improve the quality of life and outcomes of the residents. So there's a lot going for it still, and demand is also on the rise, as we've pointed out many times on here and in research notes that we do. So yeah, interesting development, but it's along the same path, and we still think the fundamentals are there for this sector.
Thanks, Richard. I think that is interesting. I mean, we have to be obviously very careful what we say with home. I think I was just struggling. But I think the main point, as we said, as Richard's saying, is that there isn't really a read across from one to the other, even though that's what we have with the share prices. So there we go.